Hi there, everyone, and welcome to On Track. It's the 29th of November as I record this. This is our end of October results edition, but all the news up to the minute. So this, as always, is a presentation for clients of McGregor Wealth Management, particularly those using our care investment methodology and process. For all others, you are welcome to listen, but please seek out advice before you act on anything we talk about here. Lots been happening, so lots to talk about. The economy as we go from this flux from higher inflation to lower inflation. How's it all going to end? And it will end. And I've got some good stats and good slides here today from our recent investment committee. We'll go through the returns, go what's happening with interest rates, inflation, and the property market. And as always, we aim to put it all in perspective so that you can not have to worry about what's going on, particularly as it comes from the news. So from the news, the Reserve Bank lifted the cash rate by 0.25%. Will there be one more? Is the speculation. You can see the chart at the bottom here. It's the most rapid rise of interest rates that we've seen in history. Now, albeit that was from pushing them down to emergency rates during COVID, when the cash rate was pushed down to 0.1%, so zero pretty much. And we've since seen that go all the way up now to 4.35%. There's speculation, the market's 50-50 on whether there's one more, on whether that's it. No one knows, of course. We've had the conflict in the Middle East, which is keeping the world occupied and watching, always horrible watching any war, causes division of opinions and other things. It has very little effect on the market, except it keeps the market cautious, particularly in the short term, and then the market tends to get used to it. And in the long run, wars kind of deliver a net positive in some ways to the market, because there's a massive cost of rebuilding, cost of munitions, etc. But in the short term, they cause disruption, and that's not to mention all the horrible humanitarian stuff that goes on. Bond yields were the story of the month. So bond yields pushed up to 5% at one stage around about the end of October, and that's why we saw October being such an ordinary month for the share market, which I'll talk through. They've retreated a bit in November, so we're back only just a little bit above where it was, say, the month before. But when bond rates go up, share markets often go down. Not always, but often. So we've seen, play out of good news, bad news. So in the States, which will lead the world on the recovery from inflation, as always, they've had a softening of employment data. Now, all this is economic language. What that means is unemployment's jumped a little bit from 3.8 to 3.9%. And of course, those are still incredibly low numbers by historical standards, but there's some more people out of work, and there's lower wage gains. And while that's bad news for the workers that are unemployed or not getting this bigger pay rises, it's actually good news for inflation, because it shows that the measures that have been in place are starting to work. So the US is starting to feel a bit more confident that they've got inflation under control. As we look down the chart, we've got the cash rate at 4.35, 90-day bank bills at 4.38, that's 3 month. 10-year government bond yields at 4.45. Down the bottom, Macquarie term deposits at 5. So pretty much good interest rates wherever you sit on that, what I would call the yield curve, from cash, overnight cash, to 3 months to 10 years to 1 year. So that mid 4s to 5%. So good returns on that. But that's now. I mean, when you invest in a 1 year term deposit, the biggest risk you have is what will the rate be when you go to reinvest your money in a year's time. Will it be the same, or will it be lower? And if it's lower, people have often missed out in a run up on the share market. The Aussie dollar, after getting down to some lows around that 63 cents last month, is now at about 67 cents. That's good news for those of us traveling over Christmas. Our dollar will buy a bit more. It puts a bit of a handbrake on our returns, which I'll talk about in a minute. We haven't quite got the monthly figure for the Australian CPI yet. That's due any minute now. US inflation was backed off to 3.2%, and I'll break down some of these numbers in a minute to show what's underlying all that. And mortgage rates, of course, responded by jumping as per the cash rate. So not good news. It's a very blunt tool that impacts only a small percentage of the population, but unfortunately, it's still the best that they have. Portfolio returns right now, to the end of October, soft. We can see if you look at the 1 year column, pretty much whether you're conservative or growth, it was around about the 4%. And that was due to that downturn in the share market, which I'll walk through in a minute. And that can lead some people to worry. But these are the prices we pay. These slightly uncertain times for that long-term returns. Long-term returns still solid, and we've seen in November a start of the market coming back. So here's the last year, and I thought it'd be interesting to stack these up on top. So at the top, we've got the 10-year bond rate. So it's the one I talk about a lot. And for most people, it's kind of irrelevant, except it does affect everything else. So if someone's buying commercial property, they value it partly based on the bond rate. When analysts are looking at value of shares, they value shares and companies partly based on the bond rate. So when the bond rate goes up, and have a look from around about March, April, when the share market bottomed the first time this year, the bond rate went up, and it went up from about the mid threes to about 5%. Now that caused share market weakness, particularly that last leg up, which was unexpected. The rise back to mid fours was probably expected. The rise up to 5 was unexpected. We saw the share market in Australia, which is the second chart here, go down, and the US, which is the third chart, the green line, go down. Not by as much as Australia. We also saw the Aussie dollar goes down. Now, there's a phenomenon here when the Aussie dollar drops and overseas share markets drop, we are sheltered from that drop. So even though the international share markets dropped, we didn't feel it in Australia because the Aussie dollar dropped as well. So our international performance is the better out of everything there. So you can see here, international equities. So IEQ here, 9.46% for that month, even though Aussie shares were down 0.71%. So that's the exchange rate effect. It's a good thing because usually when the global world slows down and international shares drop, the Aussie dollar drops as well. It does put a slight handbrake on the portfolio when world markets go up again, but we've taken some action to hedge at those lower rates of around 63 cents. So that means our portfolios will enjoy most of the gains when it goes up. The wall of worry, we're definitely in a wall of worry at the moment. The market dropped. You can see that at the last little bit there. This is the 20-year view, but it shows all these valleys of fear, the valleys of worry. So all the different fears. And the important point to note is all of these things pass. No one remembers all the drops, of 5, 10, 15, and even up to 20%. No one remembers them as we go past. They'll remember the big ones, the COVID, the GFC, the 1987 stock market crash, but they're relatively rare. They only come along every 20 to 30 years. The other ones are very regular, and it's just the price we pay. And right now we're in the valley of fear of inflation, and this too shall pass as all these others, and then it'll be off to build the next mountain. And this is the time where the patient long-term investor will eventually be rewarded at the expense of the impatient who can panic or do things, get out at the wrong time. From our last investment committee and some meetings we've had over the last month, there's some good slides here I thought I'd share around inflation in the economy. So we can see the slide on the left here shows that US core inflation, which is core CPI minus pretty much rent, has down to about 1.34%. So it's rents that have kept it high of late. And if you assume that the rental rent rises over there will normalise, then that means they've pretty much beat inflation. You can never say never. In Australia, it's a similar story. If we look at the components of inflation, the two biggest are rents at 0.6%, labour services at 0.48%. The rest of it's not too bad. So labour services is just wages. So wages have gone up a little bit. If you multiply that up by 12, you get about 5.8%. So what the Reserve Bank is looking to do is to soften those wages growths, which is hard to take for the average person working, but it's a necessary means to get inflation down. And inflation is horrible if it gets stuck in the economy for all sorts of reasons. So it actually looks like the war is being won. Australia is not as advanced as the States, but we came into inflation slower as well. So, and I'll show you some other numbers here, but some of you may remember when we were in COVID talking about the cost of containers. So all the trade around the world gets shipped, not all, but a fair chunk of it goes in those shipping containers. And during COVID, we saw the costs of containers escalate massively, which started to push up inflation of prices. And we can see we're back to pre-COVID levels, exactly. So that supply chain phenomenon of container costs has disappeared out of the system. So that's good news. The Australian economy is actually in really good shape. So this shows the household wealth and liabilities. So it's a percent of their annual household disposable income. So yeah, Australians are wealthy. We generally have wealth of about 8 times our income on average, and obviously it's very scattered amongst people. But it's a good, we are one of the wealthiest countries in the world on average. On some surveys, almost the wealthiest. We don't feel like it a lot because our media likes to bang on about all the problems instead of celebrating lots of the good things. But it's always good to check in on these things, just that there is good news in there as well. And when you look at the last 40 years, there's been 30 times share markets gone up over the year and 10 times down. So exactly 1 in every 4, which is what we expect. The share market will finish up this year. It did finish down to the year 30 June 22. So we're up, but we've just recovered some back, and hopefully we'll finish on a high note and get into 2024 with less inflation concerns. Interest rates, a note here, and that the forces that are going against inflation or disinflationary forces are competing with inflationary forces. So the battle is over who wins. So the two big inflationary forces, rent and wages, but the benefits of globalization, automation is driving costs down. And keep in mind, before COVID, we're in a state of disinflation. So inflation was very low because the cost of technology was driving prices down. So we think the battle will absolutely be won somewhere in the next 6 to 18 months, and that will lead to a resumption of the share market heading up. But there's that slight risk that the central bank pulls the levers too hard, and if they do, that might mean we push into a slowdown or even recession. Not a very high likelihood, but that's the risk. It looks like the central bank, and for us that's the Reserve Bank, will talk tough, but hopefully hold where they are at the moment. But we'll see. As I said, there's been talk of recession, but the preconditions for that, they just don't exist. So all the retail sales, savings, or population growth, all those things show slow but moderate expansion. So we're not pushing into recession. Keep in mind, a recession is negative growth, and you can see the chart on the right shows that we're still positive growth, but it's slowed. Now, once again, this is the bad news, good news cycle. Slowing growth is bad because we're growing slower than we would have liked to, but it's good because it's going to moderate inflation. So right now, that slowing growth is good news. And consumer loans, even though we've had this rise in interest rates, the percentage of people that aren't paying their loans is incredibly low. And as we said, the RBA is the biggest risk if we keep pushing rates up. So there's these yield curves again. As always, the top two charts, Australia on the left, US on the right. The blue is now where the yield curve sits, and the yield curve is just the interest rates from at call 0 right the way up to 30 years. And both the curves are really flat at the moment. But you can see the green dots, that's where it was a month ago. So we've dropped down from that 5% back into the mid-4s for 10-year bonds. And we'll see where it goes. So 4.3% in Australia, 4.3% in the States. Definitely in the wall of worry. We have the market at the moment at neutral. So we've got the market at fair value. So it is neither expensive nor cheap. It's a fair time to be buying for long-term investors, and no reason to be doing anything crazy. I thought I'd just talk about, in terms of the mess it up factor, most at focus this month, it's that short-term focus. It's when we start to get a bit worried because of something short-term. So during October, when the share markets were going down, it was the persistence of inflation combined with the hostilities in the Middle East. Put those things together and the world seems really bad. But stick the head up, look over the horizon, and it's not too bad. And as I said, those that are patient will be rewarded in the long run. And I thought I'd compound that with talking about one of the behavioral biases, loss aversion. And loss aversion is just the phenomenon where a perceived loss is viewed emotionally a lot more severe than the equivalent gain. Different studies show it between 2.5 to 3 times more emotionally that we worry about losses than we do about the equivalent gain, which is completely irrational. And that causes people to do irrational things or things they shouldn't do when markets are in a loss position. So always a reminder that is wealth destructing in the long run, which we see through that behavior gap that we talk about often, where the returns that investors get are lower than the returns that investments get because they fall victim to all these biases we talk about and do the wrong thing at the wrong times. So in our pillars, the one I've highlighted just to remind us this month is just this power of diversification. All our portfolios are just so incredibly diversified. There are no investments that can ever break us. My favorite definition of diversification is where we bargain away the right to make a killing in return for never being killed. The other, of course, is just not having all your eggs in the one basket, and your portfolio is incredibly diversified. So for the month of October, we saw minus 3.8% on the Australian share market. But if you look to the right of the top right chart, you can see that a lot of that's bounced back in November. So hopefully we'll definitely be recording a positive month in November. And that's shown a decrease in that 10-year cumulative return in the bottom right-hand corner, but still a good long-term story, as you would expect it to continue to be. US shares, much the same story, not down by quite as much, as I said, minus 2.25%, partly sheltered by the falling Aussie dollar, which is a good thing for international share investing. And the market's pretty much got all of that back in November, which is nice. Not quite at the highs of September, but it looks like the year's going to finish well, and quite incredible for US shares how good they've been for Australian investors over the last 10 years. Partly because if you look at the holdings there, companies like Apple, Microsoft, Alphabet, which is Google, Amazon, NVIDIA, which is the chip maker for AI, artificial intelligence, Tesla, Meta, which is Facebook, Berkshire Hathaway gets a mention there, but it's pretty much the first non-tech company in that top 10. So these companies are dominating the world. The Super 7, which is all the tech companies there, are up about 70% for the year. So it shows you the growth in the States is very focused on those companies, and the rest of the companies aren't doing so well. Now, that's not bad news, because it means as things steady and as the world gets back into a rhythm of growth, all those broader shares will come up as they do in the cycle. So the global leaders, top 100 companies around the world, which is mostly the same with a few extras, same story, down a fraction for the month, but not too much, and still spectacular over that 10-year period. So US small caps has tracked pretty much like Aussie shares in many ways. So it's actually down for the year, 7.8%, minus 5.85%. We've used the times that the small caps are down to rebalance. So that means we take a little bit of profits out of things that are up and buy more of the things that are down, because we know in the long run, this sector performs above average, above the main share market benchmark. So we use rebalancing just to top up during those periods of weaknesses. And that second phase, once the business cycle is completed and the interest rate cycles will stop, that will very much benefit the next phase for small companies. Emerging markets have been a tough place to be for the last 5 years, for the last 10 years, really. Conflicts, Russia, China, trade wars, all this stuff. In the long run, in theory, they should do better than average, and we should see that start to return. We're constantly reviewing. When you look at the companies in the portfolio, they're things like, Taiwan Semiconductor, Samsung are some of the ones you would know. So some of these are big global international companies, but there's a fair bit of China companies in there, and China's, through its actions of restricting entrepreneurs to some degree, I've seen some of the companies that are on par with the Amazons, the Facebooks, the equivalent in China. They just haven't grown by as much on the share market because of some interference from the government. So if that diminishes, you'll probably see them rise back again. Emerging markets are a small part of the portfolio, but important. We still think they'll add benefit in the long run. So gold up 8.68%. The benefit of diversification, having gold in the portfolio, when other things are down, it goes up, is often the way. That's why we have it there, and it's a nice diversification benefit. And for the year, 22% for gold. In these choppy years, you often wish you had more, but it's in there for insurance purposes almost, and as a hedge against the currency, and it's done its job nicely this year. Onto the property market, and as always, we talk about the property clock, but also this cycle where the market goes flat for long periods of time or stagnates, and then it can have short, rapid boosts over a long period of time. The thing driving population right now is population. So the thing driving property prices right now is population growth. So this chart shows massively, right now, population growth is through the roof. It's really just filling in the gap of the years we were closed. So it's the catch up. You think about it. The big drop was when students left the country, and then the big increase was when they came back, and then you had normal population growth. So we're not really abnormal. We'll see this tail off back into the normal range over the next year. But look at the gap. Dwelling approvals, the red line, has not kept up with the increase, and that's why the property market is rock solid. And you'll see that down the bottom as well, the new population, the per dwelling approval. These days, the average person in a house, about 1.5 people. So that shows sort of the ratio and where we're short. So 3.5 coming in, only enough approvals for 1.5 people. This will normalise. The market has a great way of responding here. People put tiny homes in the back and rent it out. They split properties into 2 apartments. There's lots of ways the market will react. It will take a while. For the moment, it's providing a floor under property prices while interest rates are working. So we could get lucky again, the lucky country, and that as immigration settles, as building approvals increase, and as we solve the problem, interest rates will probably ease back. So we possibly won't face any sort of property crisis, except for potentially a stagnation. You look at the last year, which is the right column. Sydney's up 10%, Brisbane's up 10%, Perth's up 13%. So these are quite remarkable considering the interest rate increases we've had. It was not what you would predict when you were thinking interest rates are going to jump by 4%, quite the opposite, but that's the population growth at work. Now the turnover not quite as high, so markets aren't crazy. And keep in mind, a lot of this was a recovery because the year before was fairly soft. Rates up a little, so up to 6.32 of that 0.25%. But you'll see, the variable rate hasn't moved that much. We've come up so much from the lows of COVID. But look at the chart on the left. The fixed rates are all converging about where the variable rate is. Now, that's a fair sign that the market, the banks that set these rates are kind of thinking rates are about peaking. There's really no point fixing at the moment unless you really wanted to just insure rates against very, very unexpected rises, which don't seem likely, but anything's always possible. So it's not, it wouldn't be there's no cheap fixed rates at the moment, so not something worthwhile. Our performance property data that we get from our friends at Performance Property shows that, different cities at different stages. This has moved around a bit in the last few months. So a large cluster, and the houses are on the left, the units are on the right. So a large cluster of cities in Australia, like the Sunshine Coast, like Melbourne, Brisbane, are in that sort of still going up, but they're kind of getting towards that hold stage. And at some point, they more than likely will come down a little and probably stagnate for a while. But there are still places you can buy that these guys have pegged in the value area. So places in WA, Perth, Rockingham, Mandurah, Bunbury, and some in remote Queensland. Be careful where you buy. Always happy to talk to you about strategy, both short-term and long-term. And I should point out, even though Sydney's on the stagnation there, Sydney's been one of the best performing property markets in the world and will still continue to do so. So if you're buying a property in Sydney now, even if it went down in the short term, you're likely to do very well in the long term. You just may be worried about it in the first few years. But ultimately, pretty much most places in Australia will do fairly well over the cycle. But we do prefer capital cities and those cities or towns within about a 2-hour drive there. But yell out to the team if you're thinking of either selling or buying and how it fits into the cycle right now. So wrapping up, as we always say, all investing is best done as part of a real financial plan. And that's where you've got proper goals that are based on your life and your world and what's important to you. Portfolio is designed to meet those goals. We do take a long-term view. Massive diversification, getting the asset allocation right, and always making sure you've got liquidity. And we get the exposure to most of our growth markets through index funds, which gives us low cost and consistent results without ever trying to shoot for the lights out. Protecting its short-term volatility through those reserves for our retired clients and dollar cost averaging for our wealth builders who are still working. And boring but beautiful rebalancing. Every time there's volatility, your portfolios make a little bit of extra money by being rebalanced. That's where we sell a little bit of some stuff and buy the stuff that's down, which often gets undone when it reverses. And that's a free, one of the only free lunches in investing, worth probably 0.5 to 1% a year of returns. As always, I point out there's only 3 ways to lose money and not to do them, which none of our clients do, which is panic and selling, having to sell when the market's down, or not properly diversified. I'll speak to you once more before Christmas. It's the silly season has started. Enjoy it, and I'll speak to you soon. Rob McGregor signing out.